Hello, everybody. Welcome to the Untrained Professionals Podcast, Episode 5. I'm your host, Ryan Cohn, joined today by my co-host, Anders Young. And today we have a very special guest on, Sergio DeCesare. I hope I said that right. Sergio is a certified business coach, business exit planner, profit and growth expert. And in addition to this, Sergio has a real estate brokerage, a business brokerage, and has flipped and sold homes for many years. So we're going to be diving into his investing strategies, his take on where the housing market is right now, and why he decided to offload his entire real estate portfolio over the last couple of years. Sergio, thank you so much for being on the show today, and especially being on a holiday. Happy Father's Day. Really appreciate you carving out some time to hang out with us.
Not a problem. Pleasure to be here. It's good to be with you guys.
So just wanted to start off the conversation. I know you and I have talked about this, but so people have a better understanding of who you are, what you do. We'd love to start off this conversation with you sharing a bit about your work history, your focus, what got you interested in real estate investing, and specifically the fix and flip method.
Sure. So, for the last 10 years or so, I've been doing multiple things. I'm a business coach, certified business coach, as you mentioned. But I've been in real estate probably since I got out of the military, or my interest and my love of real estate has been since I got out of the military back in 1986 and 87, which might be before a couple of you guys were actually walking the planet. So one thing I realized when I got out of the military, and I was tired of being shot at, I decided, I wanted to have wealth, right? And back then, the consensus was there was only two ways you're going to be wealthy, and that was inheritance or real estate. Now, of course, I think a lot's changed since then. I think being a business owner also gives you an opportunity to get wealthy, but a lot of business owners also invest in real estate, and that's where they build their wealth of, as they go on, included in that. So, one of the first things I did, and back then there wasn't a whole lot. There was a lot of books. Okay. I think one of the great books back then was No Money Down type of books. And there was a gentleman who had a late night infomercial, which I ended up spending some money on. And quite honestly, it was a good thing because it got me really started and motivated in the real estate world. But oddly enough, my first real estate deal was not a real estate deal. It was a note deal. And a lot of people were, okay, well, what does that mean? Well, basically what I did was, and this was one of the modules in that course that I'd taken, that you go and find somebody who's holding a note on the sale of real estate. Okay. They took back a mortgage when they sold it. So the buyer was making payments to the owner, the new owner. And, at some point they wanted to cash that note out. So maybe it was a $20,000 note. And they were holding $20,000 note, getting an interest payment on it, but they kind of wanted to cash it out. So what I did is I went in there, made some calculations, and I think they had maybe, $18,000 or $17,000 left on the note. What's not been paid. Yeah. And I went in there and I offered them like 14 or 13. And so they took it, and I immediately flipped that note to a gentleman in New York who was accumulating these notes for the cash flow. So he paid me a little bit more.
Oh, wow.
There was about a $1,600 spread in the whole thing.
Oh, interesting.
So you were kind of doing, what the mortgage lender does when they sell me a loan and then they flip it to somebody else right away. Except you're doing
if it's a portfolio loan or if it's a private money loan, absolutely. Yeah.
Interesting.
But you take less. You have to take less for the note than the face value, because especially if you've got a number of payments already paid in, you've earned that money back. So you have to, make sure that you count that when you do your calculation. So all in all, it was $1,600 payday on the first deal I ever did. And I didn't really have to do anything except get some documents for assignment of mortgage and stuff like that. So it was kind of cool. And ever since then, I was pretty much hooked.
Wow.
Interesting. It's kind of like wholesaling, but I haven't heard of note flipping before. There's
Really?
so many different, there's so many different models. Honors, have you heard of that?
No, I had not. I understand the concept. I just never heard of somebody doing it just like a private guy. So that is kind of a cool cool entry point to get into.
Well, put that in your toolbox, guys, and learn about that, because actually, I think it's a good tactic to have. It's a good tool to have because, look, I like owning real estate, but I love controlling it more than owning it.
Yeah.
So when you're dealing with notes, like one of the other things I do is I loan money to people. Not big amounts. Sometimes they have back taxes. They owe 5,000 or 10,000 or 20,000. And, if they don't pay that for the taxes, their house is going to get foreclosed at the county. They're going to put it up for a tax sale. And I was involved in tax deeds for a long time. And so even now, like I will lend them this money starting at around 18% plus points, and I actually can control that real estate to a certain degree because they don't pay me. I foreclose. Whether I'm in the first, second, third position doesn't matter, because once the foreclosure action started, everybody's got to come to the table.
Gotcha.
So, I can make 22, 25% or more, depending if there's late fees and they pay late, which I always love when they pay late, because that means I get an extra 5% on my yield.
Yeah.
Right. So, but I get to control that real estate without having to pay the taxes on it, the maintenance on it, and all of those stuff that goes along with it.
Interesting.
Wow.
So when you're doing it, go ahead, Anders.
Sorry, how do you find, you say you've been doing it for a while, but now how do you find like situations like that where somebody needs that capital?
Well, I have a client, I taught how to do this. And after 4 years, she still wants to pay me every month to consult with her and find the deals and everything else. And basically what I do is I have her put the ads in Craigslist and other places online saying we loan money, you have secured by real estate, whatever, blah, blah, blah. And whatever deals she can't afford to make or doesn't want to make, she'll send them over to me. So I get a supply where I don't even have to market for them.
Wow.
Matter of fact, I just made an $18,000 real estate loan 2 months ago. We closed it.
Interesting. This is blowing my mind.
And people, and some people are like, well, at the end of the term of that, what are you going to make? Well, maybe I'll make $3,000 or $4,000 interest on that loan. And they're short-term loans. They're 2 years, 3 years or less. We're not going out 10 years. So the payments are pretty significant. But I'm not waiting 5 years just to make, 18%, because the state of Florida caps me at 18%. But I can put other fees and other things in there that I can increase my yield with.
Interesting. So what are they advertising on Craigslist?
I think is primarily, yeah.
What are they saying though? They're saying like, do you owe money on your I guess maybe I don't
back taxes. Do you have
back taxes?
A payment or a roofing you need done that you can't afford to do right now? It's really weird. We started off doing that just for land deals, finding land deals like that. Because a lot of times if they haven't paid the taxes in a couple of years, depending on the value of the land, they probably may not pay us too, which is okay because now I get the land. So it's very similar to a tax deed situation. And I used to do a lot of stuff in tax deeds. Now, if you go to a tax sale, it used to be the interest started at around 18% with the county. You get the certificate, boom, you get 18%. Then the banks started coming in, and they're like, well, hell, we'll take everything you got, and we'll only expect 5%. So for the rest of us, I was like, oh, you guys suck. You just kind of ruined the cash cow for us. But the flip side of that is, a lot of people don't make the payments on the certificates. So after 2 years in the state of Florida, you can file for foreclosure. So these properties started coming up on foreclosure for tax delinquency. And a lot of times we would reach out to those people before the foreclosure date and say, do you want this or not? Because we'll help you keep it. Here's what we can do for you.
Oh, so you'll find out people who are in pre-foreclosure or whatever for that, reach out to them and then make that deal.
Yeah.
Wow.
And that's how we got started in the business. Now, I don't do that with single family homes anymore because it's a whole nother can of worms when you're dealing with somebody's primary residence. But if you're going to take out a personal loan from me, okay, not to put away a foreclosure, but if you're going to take out a personal loan, let's say you want to do renovations or you got back taxes before anything's been filed, we'll loan you that money. because now, even though it's secured by real estate, it's not considered really a real estate loan.
Interesting.
Yeah.
So you started out by loaning people money, and then at what point did you transition into purchasing real estate and
I've only
focusing
been
on
loaning
fixing and
money
flip?
out for the last couple of years.
Oh, I see.
Before that, I was fixing and flipping. We actually got into the whole, you guys probably don't remember, or maybe you do, you're kind of young, but 2008, 2009, 2010, it was pretty much a shit show, pardon the French. And, I had sold an IT business at the time that I had, and, I was trying to figure out what I wanted to do when I grew up. And I had a friend of mine who was an ex-Marine, ex-military as well. And we both had brokerage licenses. So basically from Tampa South, we were looking for short sales. I've closed over and negotiated over 300 short sales in about a 5-year period. And
Wow.
those ones during that time. And those, to me, 300 doesn't sound like a lot over 5 years, but you got to remember, we had to pick and choose what we wanted, because what we were doing is we were actually buying those properties. I had the brokerages set up for buyer and seller side. We were getting the commissions, and we were actually purchasing those properties and flipping them to other people who want to buy.
You'd basically buy the contract for all these properties, and then you find a buyer.
Well, when you're negotiating on a short sale, when you're negotiating on a short sale with the bank, they want their cash. So what would happen is I would negotiate a price, like let's say the homeowner, and this is very typical, homeowner owed $200,000 on the property, right? They were into the note for $200,000. We would go in there and negotiate the lowest possible price. Could be 140, could be 130, could even be 100,000. With the contingency that they released the homeowner from further collection activity. That was always the caveat. We never went in there and snatched something from somebody and then let them deal with the ramifications of not paying your mortgage. And we never did that. Matter of fact, state of Florida investigated me and wanted to make sure, because somebody had said something, and they came in and sat in my office for a week looking at every single deal.
Wow.
And I had 10 separate disclosures to homeowners alone. They knew exactly what we were doing, why we were doing it, but the contingency was the bank had to release them from any sort of liability and collection, which most of the time they do. If it's a primary residence, and then the government stepped in and said, well, if you had a short sale, in 2 years, we'll let you buy a house again, whatever, blah, blah, blah. So it kind of worked itself out. But, at the end of the week, when the state was in my office going through all my files, they were like, well, we don't understand how you're doing this. I mean, you're buying it from the bank in the same day that you buy it, you're transferring title out to somebody else. And back then we called that a dry closing. They don't let you do that anymore. They want you to fund the actual deal, put the money in the bank, whatever, which at the time we were like, nah, we're taking out that buyer's money, we're putting it in, and then using that to pay the bank. And we keep the spreads. But now you have to actually fund it. So that was one of the things that came out of the legislation. But, at the end, the state's like, they're like, we don't understand how you do this. I actually had to take 3 hours and walk them through a scenario because they could not understand how I mean, you guys probably understand it perfectly.
Yeah.
But, investigator at the state's attorney's office is like, I don't understand how you can do that. How can you sell something you don't own? What do you mean I don't own it? I closed on it 5 minutes before I sold it to them.
Yeah. So but now you're saying they changed that law. Now you have to do a full close, take title, and then do
what they call it is
another sale
closing.
after.
It's a wet closing, which means you can do it all in the same day. The difference is, like, the money that I can't take the other buyer's money and give it to the bank. I actually have to wire my funds into the account and the title. And I think this is something more that the title companies kind of really wanted to see, because they got real nervous, because toward the end of this, 2015, the banks started putting these deed restrictions in our approvals. Bank of America was notorious for this, and they're probably the biggest criminal in this whole situation. And they would put these deed restrictions that said, okay, well, once you own it, you can't sell it for another 30 days or 60 days or 90 days. And we're like,
man.
look, how do you figure? I own it. How can you stop me? Well, they couldn't, but they put the fear of God in the title companies, and the title companies said, well, we don't want to get in trouble because there's a deed restriction here. Yeah, but it's an illegal deed restriction. So I actually only had, at the time, had one title company out of all the title companies we dealt with, and we're looking for others. The only ones who would do it, the underwriters, not so much the companies, but the underwriters, the only people who would do it and recognized what I was saying was absolutely legally correct, was Old Republic Title Company. They're the only ones that are like, yeah, no, they can't, they can put it on a deed, but we'll close it for you.
Wow.
Yeah, it was an interesting time in real estate. It was crazy, Wild West.
So you did over 300 transactions this way.
300 short sales.
That's mind-boggling. That's a lot.
Well, it is when you realize, and to me, like 300 over 5 years doesn't sound like a lot to some people, but when you realize I was negotiating every single deal. I was negotiating with banks on the East Coast, negotiating with banks on the West Coast. My days were long.
Oh, yeah. I could imagine.
And a lot of these properties had multiple lenders on them. It wasn't like I was dealing with one lender. A lot of these properties had a lender who was BOA, and then the secondary lender was some little bank out of California.
Right.
So what was that process like? Like what were you doing to find those deals? What were the negotiations like? Were you dealing with the homeowner at all, or was it strictly the banks? I'm just curious.
Both, actually. Finding the deals, it was pretty simple. When a large percentage of, homes start failing in their payments to the banks, in Florida, we call that a lis pendens list. When the action is filed, it's easy. You go to public record, you find who's got the filings against them, and you start contacting them. And then, by the second, third year, we've become pretty well known in the area for getting people out of their mortgages without, further bank collection activity. So finding the deals weren't that hard at the time, and such a large percentage of them. I mean, I don't know, Anders, if you remember, like Cape Coral was the epicenter of all foreclosure activity in the United States.
I did not know that.
Yeah.
Wow.
Yeah. But Florida was definitely one of those cyclical markets that took a much bigger dip, just like California during that time.
Absolutely. So finding deals weren't hard. It was, it was a learning process in the short sale process, because a lot of these banks and these lenders had no clue what they were doing. And most foreclosures in judicial states, and Florida's a judicial state, and basically what that means is it has to go through the court, before it can actually grant possession to the lender. Where some states you don't really have that. It's done through the sheriff and stuff like that. But in Florida, it's a judicial state, and the courts were so bogged up with these foreclosure cases and eventually eviction cases in some cases, because if people don't leave, they got to get evicted, right? That the process sometimes I've had. I think the very last short sale I did was a friend of mine at Cape Coral, and that took pretty much about a year to do from start to finish.
Wow.
Yeah.
Yeah. I mean, during that time,
you're really happen in a year.
Yeah.
And not only that, but because it was so out of control, and the banks had never seen anything like this. I'd be halfway through a negotiation. Hell, I'd almost practically get an approval, and then they'd switch negotiators on me.
Oh, jeez.
Oh, wow.
And when you do that, and if you understand the process for short sale, and when you're dealing with these loss mitigation departments, it is just a pile of paperwork. We were faxing so much stuff. They want, they have to fill out the hardship letter. We'd help them write the hardship letter. We want 3 months tax return, or 3 years tax returns. We want 3 months bank statements, 3 months expense. I mean, it was grueling. A lot of, the homeowners are like, oh my God, this is like worse than, being audited by the IRS. And it was just awful. And then, you get a new negotiator, and guess what? Oh, we want all that stuff all over again. So everything has to be updated. So it's like, holy shit, these people.
Oh, man.
But I think that was a tactic too. Because a lot of these banks, what they come to realize later on is they didn't really want the foreclosure.
Mm-hmm.
You know, they didn't want it sold. They wanted possession later on, because a lot of these banks now, you know, REO properties,
Mm-hmm.
you know, they set up their own departments now. A lot of them have, you know, if you look at a foreclosure now and you go to buy a foreclosure,
Mm-hmm.
even on the steps of the courthouse, you're going to pay market or over market. It's crazy.
Yeah. I mean, I think back then banks weren't really set up to have actually be able to manage rentals and things like that. Whereas
No
nowadays, some
way.
of them actually will. You know, like the house that I bought a house
Correct.
that was a rental managed by a bank, and then they were just trying to get it off their books.
Yep. My point exactly.
Interesting. Yeah, I mean, it's slightly off topic, but you know, when COVID first hit, the PPP funding became a thing, and I just remember going through the paperwork, and they make you go through the banks, and it was such a convoluted, confusing process. Like they almost didn't want you to file it. It seemed like, and they
Yeah.
just weren't. And it was, you know, all stitched together last second. But
And let me tell you, I did the PPP process.
mm-hmm.
You know, we received funds, and I got to tell you, that was 10 times easier than anything we ever had to go
I
through for
bet.
short sale.
Wow.
Because at least with the PPP process, you went to a website, you started filling things out.
Mm-hmm.
Banks didn't have anything like that. Half of them didn't
Mm-hmm.
even really have loss mitigation departments. I mean, big banks would have 2 people in loss mit, you know, and they've got millions upon millions in loans that are defaulting. These guys didn't know, you know, which way to turn.
Well, so did that sort of short sale process and like the work you're doing then, did that sort of slow down or end once like they changed the laws, or once the market sort of started going back the other way?
Well, honestly, they started changing the law every chance they got. I belonged to an organization. We actually had a lobbyist, and I was telling Ryan that we would meet up in San Diego there at Torrey Pines 4 times a year, and we had a lobbyist in Washington, and they were just very intent. Washington was very intent on placing the blame of that whole catastrophe on the shoulders of investors.
Mm-hmm.
That was their goal, and it wasn't accurate. It wasn't true in the least. Yeah,
Right.
a lot of investors got mortgages, but a lot of mortgage brokers went to jail because they lied on the applications. And a lot of them happened here. I mean, you know, when you have 2 people who barely speak English from another country buying a $300,000 house on an adjustable rate mortgage, and they both work in food service at the hospital, how did you get that application approved is what I want to know.
Mm-hmm.
Yeah.
And there was a lot of that going on here. I mean, locally, that was a big thing here. You know, how the hell did you buy a $300,000 house?
Right.
You guys make $14 an hour.
Yeah, it's probably a lot easier to blame. To blame a bunch of investors that, you know, instead of a big bank or one corporation, you invite, you know, just blame a bunch of little guys instead. They
Of
can't really
course.
defend
Of
themselves.
course. So I mean, there were times we'd call it Blossom Inn. We'd want to make an offer on a property, and before, you know, they say, "Well, is this going to be a primary residence for the buyer?" Well, the buyer was my other corporation with somebody else at the helm of it. You know, are they going to be living in a house? Well, no, this would be an investment purchase. Oh no, we don't deal with investors. You guys caused all this. Click.
Oh wow, that's so
Can you
crazy.
imagine?
How bizarre.
Right? Can you imagine?
Wow. It's very interesting. So, from buying short sales or doing the short sale process, did that sort of lead into you doing fix and flips and buying your own real estate and holding it for some time and getting your hands dirty, or how did that work?
Yeah, the short answer to that is yes, because, you know, at some point now, even the title companies were like, "Look, you know, you got to hold the property 30 days," or, you know, so then we're like, all right, well, if we're going to hold it for 30 days, we're going to put some improvement in it and get a higher price when we sell it. Right? Just makes sense.
Mm-hmm.
But, you know, it also causes other problems too, because now we have to get money to fix and flip it. Right? So that usually came out of my pocket. And then we started switching over to, you know, using hard money lenders for the purchases and stuff like that. But yeah, eventually what happened is we had to hold these properties 30, 60, 90 days, fixed them up and flipped them. And I have a construction background, so a lot of that stuff was not that big of a deal to me. A lot of cosmetic stuff mostly. You know, we didn't buy a house that had some real structural damage.
Mm-hmm.
It just wasn't worth it, especially for the price that they probably want us to pay.
Yeah.
So
And
yeah, that's how.
the market you're doing this is all kind of in the Tampa area. You're just sort of all around Florida.
St. Pete south all the way to Naples. We've
Okay.
done a few things like toward the center of the state, a little bit away from the coast. But I live in Naples, so it was just easier to drive up and down 75,
Oh, I
I-75.
got you. Okay.
And we were actually based in Charlotte County. My partner lived in Charlotte County.
Okay.
Hmm. Hmm.
So, and you basically had construction experience. Like, what did you do that? Like, what experience did you have, or how did you learn that?
Well, I owned with my father a construction company, and I should say he really owned it more than I did. I just happened to go get the license for the construction because he
Oh,
was
so
in
you had a
he was.
GC license.
Well, I didn't have a GC license. I had a subcontractor's license for plastering, stucco, drywall, and all this other stuff.
Okay.
But
Hmm.
I'm Italian. We build our own stuff, man.
Yeah.
And every house he's ever built down here, he was owner builder on, and we knew everybody in every possible aspect of building a house. So
Mm-hmm.
there was no reason to pay that premium to a builder. We knew how to do everything.
Right.
So I learned, some things from the old man. Owning a house of my own for the last 28 years in the same house, you tend to learn some things to fix
for sure.
your house to keep from calling people. So, and a lot of stuff is easy. And I had another partner on the construction side who knew everything from laying tile to painting to all that other stuff. And I usually handled the interior walls and stucco on the outside if there was any. And we made a good team. So we were able to keep a lot of that stuff in-house rather than having to pay. I think if we had to pay other contractors to do things, we probably wouldn't have made that much money.
Hmm.
And how many of these are you like taking on at a time when you're doing these fix and flips?
Back in the day, we probably couldn't handle more than 2 or 3 at a time because you're limited in funds, especially now that we had to come out of pocket to buy materials and fix them and stuff like that. So a lot of that was self-funded. So,
okay.
But, we can turn around a house in 90 days.
Yeah, no, that's quick. And what kind
of... Turn it around and sell it in 90 days.
Yeah. And you're borrowing hard money to sort of fund this thing. And what kind of rates are you paying back at that time?
Well, back in the day, I was probably paying, Florida caps it at 1.5% a month. But, if you went over a month, they would tack on another 0.5% or whatever. So it starts adding up if you let it go.
Uh-huh.
When you're talking about, $100,000, it starts adding up quick.
Yeah. And then, so you're starting to do fix and flips, and are you holding this kind of for your minimum, whatever, 30 days or 3 months, however long it takes you to get it done? Or are you turning a lot of these into long terms at that time?
Everything we did on the short sales side, we flipped out. I didn't hold any of that stuff. My personal holdings in real estate was stuff I bought from Fannie Mae or Freddie Mac on the foreclosure sites and stuff like that. It's landlording is not what it's been cracked up to be. And especially if, most of the bulk of my properties were in North Carolina.
Okay.
And I was in Florida. Sometimes it was a real pain in the ass.
Yeah, I can imagine.
Yeah, I've had rentals. I've had a number of rentals up until about 1.5 years ago. And then in the last, when was that last sale? Probably 9 months ago, maybe a year. I sold the last property out of state.
Okay.
The prices were too good.
Yeah. No, that was definitely probably the peak of the time to do it. Did you
understand?
Yeah.
Understand a large percentage of my properties were also Section 8. So, these tenants didn't really treat the property with a lot of respect. So I'm looking at prices where it's like, man, I don't have to fix a thing. And you almost get the same price that I would have got if I fixed it up and sold it a couple of years earlier. So I said, take it. I'll sell it.
How did you get involved in doing Section 8? What was that kind of process like?
Getting involved in Section 8 is basically probably, I call it an act of desperation, but I know some friends of mine who are in the space and they actually teach rentals with Section 8 because they said, well, it's a guaranteed check.
Mm-hmm.
Well, it's a guaranteed check for a certain portion, but the tenant still has to come up with their portion, and they can still very well default on that.
Right.
So, but all in all, the standards for Section 8 properties, everything has to be in working order. If the tenant breaks something, breaks a window, or the screen is no good, you got to fix all that stuff. There's no negotiating it with the tenant. Section 8 says, well, you want to keep getting money from us, that window's got to open, that window's got to close, that window's got to have the glass replaced, So to me, that was kind of like, it's a pain in the ass.
Not worth
And
it.
a lot of these Section 8, you understand too that a lot of these Section 8 divisions in the county, it's all governmental. They're very, very pro-tenant, but not very pro-landlord.
Gotcha.
So they will they'll make excuses for a tenant. They'll, they can make your life hard as a landlord if your tenant complains.
Did you ever have to deal with squatting or anything like that after?
Not really, because I had a interesting and effective way of managing my tenants through legal means that would pretty much scare the bejesus out of them.
And you got to be able to do it. It's something I worry about, especially in California. They're very pro tenant here, but I think with short term rentals, hopefully it's not as much of a problem.
Yeah, unfortunately, a lot of the courts are very pro tenant.
Yeah. Like at this point, so you've sold everything you've got, and I'm kind of curious if you want to like switch gears as to what you would need to see for you to want to get back into real estate, because with the Fed, we've been like hiking rates for almost every single month, and then now at this last meeting they said it's a cut, but it still seems like kind of hawkish, like we don't necessarily know where they want to take rates. So I'm kind of curious, like what would you need to see in the market for you to be like, all right, I kind of want to jump back in and build up my portfolio, or here's where I think the market's going to go, and like what are your thoughts on that?
Well, it ain't over till it's over, and it ain't over. What the Fed just did wasn't necessarily, we call that the pivot, but it's not a pivot. It's only a pivot if they start reducing the rates.
Right.
So they pretty much called it a pause, or I think someone mentioned the word skip.
Yes.
I don't think they're done raising rates because I don't think inflation is really contained yet. It's when they talk about, well, at its peak, inflation was 9%. Really? So you're telling me for every dollar we spent, it only went up 9 pennies for the things we buy? Show me where that is, because I can tell you, being a business consultant, I've seen my customers' inventories and the products they buy, whether they're landscapers or anybody else. Everything's been a minimally 30% increase, minimally. Minimally. A lot of times it's been 50%. A lot of times it's been 100%. Chemicals and stuff, some of them have doubled. So I don't know where they come up with 9%. I think anything they tell you at this point, you better add a 1 in front of it.
Yeah.
I think it's closer to 19% than it is 9%. And so they're like, recently they said, well, we're pausing because we think it's starting to come down. And so, inflation, the rate of inflation now is only at 4%. Well, no, you went from 19 to 14%, basically what you did, but it's not under control yet. It's not even close. And that's what a lot of that is what's caused the housing prices to go up.
Right.
Okay, the inflation. And also in the case of Florida, some of it's a little bit of migration. I mean, it's not as much as you would think. People think, oh, all these people moved to Florida. Everybody vacated the north and came to Florida. Well, no. I mean, Florida, up until last year, the migration difference was only an increase of 1%.
Yeah.
Now it's up to 3%, in the latest thing. But okay, guess what? I know a lot of people leaving Florida after this last hurricane.
Yeah.
Between homeowners insurance and just the fear of going through something like that. And Ian was pretty rotten. I
Oh
mean,
yeah.
basically, yeah. If you're in Florida, you've heard. But I
No,
mean, Fort Myers Beach doesn't exist anymore,
right. No,
and a lot of people
especially
are terrified.
yeah, the homeowners rates like it for the insurance, and now it sounds like everybody's gonna have to start getting flood insurance. They went up like
I don't have to have it. I'm
astronomically.
lucky.
Yeah.
Yeah, I don't have to have flood insurance. I got rid of it about a year ago because actually went and got an elevation on my property. I said, I don't flood here. I'm not paying flood insurance. So they said, well, you're welcome to get an elevation if you could prove it to us. So I spent
Okay,
$350 to prove it to them.
that's what I was thinking about doing for my house. The flood line runs right through my house on the FEMA map, and I was like, I'm wondering if I can get an elevation, if I can just get out of this altogether.
You can. I would. It's like $350, and in my case, the elevation was 16 feet above sea level, more than enough. I don't need flood insurance. And the problem with the flood insurance was every year my rate kept going up.
Yeah.
I started off at like $400 a year, went to $500, then went to $600, then went to $800, then went to $1,000. I said, enough's enough.
Yeah.
I'm
It's
never
out of
going to be
control.
flooded here.
Yeah.
What's your flood rate, Anders?
It's like $1,800 a year.
Wow.
How much?
It's $1,800 a year.
That
It's out of
homeowners
control.
or flood?
That's just my flood. It
That's
went
incredible.
up. It's like, I don't know how they can expect people to pay this, because if you're just a regular homeowner, and you got your mortgage and escrow and everything, then
Right.
your bill might, if your homeowner insurance goes up too, your bill might jump $300 out of nowhere, and
Oh,
that's a lot
easily.
for some people.
Look, I got people. I mean, I'm going to states. If I go into town here, if I go south 5, 6 miles, 7 miles into town to a place called Golden Gate City, which is a smaller area, I got clients in there who are paying $1,800 a year for homeowners. Okay,
Mhm.
they got dropped and they're shopping it, and they've got two insurers that came back and said, "Yeah, we'll take it for $8,000 a year." From
That's
1,800.
horrible. Yeah,
1,800 to 8,000.
Wow.
it's like criminal.
Your mortgage payment just went up, what, $100 easily? Maybe $150 a month just to cover that? What's
Wow.
8,000 divided by 12?
That's like 300 or 400.
Okay, it's a little bit more, right? So,
Yeah.
and they're like, we may just have to leave Florida altogether or move to a different part of the state where this isn't a problem, because we can't even afford that. I've owned my house 20 years. I can't afford the homeowner's insurance anymore.
Mm-hmm.
Wow.
Yeah.
Insane.
So, talking about going back to the migration point in Florida so a lot of people, they're like, okay, we're not going through another hurricane like that. Or we're going back to where we came from. You've got these people who now, because of the hurricane, the insurance is off the charts. Now the flood is off the charts. Now, because of the rise in the values over the last couple of years, if you own a second home here, your taxes just went up tremendously as well.
Mm-hmm.
Okay. And plus, up until recently, I've been a single guy most of my life here. And I've met a lot of single women who've moved down from other states. They got divorced. They come down here. They get a job. They rent a place. The rents now have gone up so high where these same people I'm talking to, they're like, I got to move back to from where I came from, because in my job, I can't make any more money to pay the 20 or 30% increase in my rent.
Yeah. No, I heard a statistic the other day that it's approaching like an all-time high of, the percentage of people's income that they're paying, for their rents right now, which is not it's not a healthy statistic where we're at right now.
Well, I mean, when you compare it to, qualifying for a mortgage, I mean, a healthy number, you should be paying somewhere between 30 and 40% of your income toward your housing. 40 might be a little high, but in FHA, they're a little liberal. I think they go 40, 42%. Typically here in Naples, you're up around 55%.
Yeah.
Which is, to me, insane. I would never. No way.
Yeah, that would scare me.
Yeah.
Totally.
Yeah, well, think. I mean, you're young guys.
Mm-hmm.
Think of the people here who are 40s and their 50s. They're looking at some point of retiring. How do you save any money doing that?
Yeah.
How do you invest in anything else other than the place you live?
Yeah.
When you're paying 55% of your income for housing.
Right.
It's terrifying.
Yeah.
It's definitely.
It is.
And is that why you feel, because we've talked about this before, but why you feel real estate is due to have a correction is just, it's going to reach a breaking point of some sort?
Absolutely. Typically, and I know you guys are involved in real estate, but you really need to look at the cycles. We talked about this, Ryan, before, about how real estate actually goes through these up and down cycles. It's a natural thing. It happens.
Mm-hmm.
Okay. There's never a straight line up or a straight line down.
Mm-hmm.
It happens in cycles and waves, right? So typically, a real estate cycle, depending on the area, can run anywhere from typically 15, 20 years, maybe, depending. COVID kind of crunched that in a little bit. There was a lot of artificial things that contributed to the values going up at such a high rate.
Mm-hmm.
So, yes, the typical economic cycle has an effect on real estate, i.e. recessionary pressures. But with everything else going on, okay, now, you're coming off of COVID. Now you got these moratoriums lifted, these restrictions lifted, taxes are up, insurance is out of control. There's a lot of other factors that sometimes we don't even see in a recessionary period for real
Mm-hmm.
estate that are now hot and heavy. Student loans, they're going to have to start paying them in the next month or two. They're back to that.
Hmm.
45 million loans out there. I think 900,000 are actually paying them. So there's going to be a high level default. There's a high level default for car loans. And of course, with inflation, trying to buy a car, shit, I might as well buy a house for what they want for a car.
Mm-hmm.
I mean, a friend of mine just bought a brand new Tahoe or something. I think he paid $70,000, $80,000 for it. I'm like, dude, you buy a house in other parts of the state with that, So,
it's ridiculous.
So you have these auto loans, they're going to be in default. Credit card spending right now is at all-time highs. Savings rates are at all-time lows. So there's all these other things that the general population doesn't really see. But, me and my group of friends and people, whatever, we kind of track this stuff because we know they are indicators of what's to come.
Mm-hmm.
So as far as my strategy for what's going on right now, it's not the time yet to buy. Our pricing here has only come down maybe 5 or 6%. Inventory is still low. It fluctuates. Inventory is going to go way up. But, here's another thing, too. We're not waiting on inventory to go up to signal another signal, because all these people who bought, and by the way, a couple months ago, Naples was indicated as the number one spot in the country where mortgages are at risk, which is kind of weird, because when you talk to the realtors, they're like, well, that's bullshit, because every deal here was done with cash. All these deals, we have a high probability of cash deals here. Okay, well, understand this. I said this to my guys who do the research. I said, that doesn't make sense to what the realtors tell me. They're like, here's what you got to understand. The realtors kind of caused this themselves. They told people, well, if you want the deal, you better pay cash. So then you'll have the advantage over anybody getting a mortgage.
Right.
Then you got to waive your inspections, because if you're going to have some inspection time, so just gave it to someone who has, no inspection period. But what happened is they got the deal paying cash. When they closed the deal, they refinanced out of the house again to fund where they took the money from. In a lot of cases, that was 401ks and whatever, IRAs, retirement money. So, the deals were made in cash, but they were refinanced as soon as the deal closed. And half of those mortgages, based on just a little change we've had in values here already, 50% of them are now at risk. That, to me, is an incredible number.
Okay, so you think...
So going back to the inventory point, the point is, if you're paying 2 or 3% on a mortgage, or 4% on a mortgage, and you kind of want to sell, are you going to sell right now?
No way. Yeah.
No, because you're going to have to buy something someplace else, right?
Yeah, and then get on for 6 or 7 or whatever it is.
Yep.
So that's why I'm not really putting a whole lot of stock into inventory. But, the numbers we were talking about, they were talking about last night, Eviction Labs. That's the place I was talking about, Ryan, that I couldn't remember. Eviction Labs. They're talking about evictions and foreclosures are climbing to a point where it's almost off the charts right now, based on moratoriums and all the COVID funding disappearing and everything else.
Mm-hmm.
Because I can tell you, as a tenant or as a landlord back in the COVID period, I couldn't touch my tenants for eviction. I mean, some of them were sitting there and not paying for months and months and months. And some of them I actually kind of played them a little bit, and I didn't send them a lease to renew. And when you don't send them a lease to renew, that's breach. They're living there in breach of a landlord agreement.
Mm-hmm.
That I could get them out for. But the fact that they haven't paid me for 3 months, the judge said, nope, moratorium, can't evict them for non-payment. This is the stupidity of it all. I couldn't evict them for non-payment, but I couldn't evict them because they didn't want to sign a new lease.
Wow.
Go figure.
I'm gonna have to remember that one if this ever comes around again. That's a good one.
Interesting. You come up with very creative solutions, Sergio. It's pretty.
Well, sometimes you have to, brother. Yeah, and to tell you the truth, I actually had to come up with that one because my attorney I hired in North Carolina was telling me we can't get her out for non-payment. I go, can I get her out for not wanting to sign a new lease? And he looked at me and he said, well, that's possible because that's not part of the moratorium contingencies.
Wow.
I go, get up there and go talk to the judge. What are you talking about? And that's when the judge said, she didn't want to sign a new lease? Okay, she's out of lease. Possession.
Dang.
Yeah, it's kooky. Craziest thing I ever saw. But that's what happens when you also have pro-tenant judges, right?
Mm-hmm.
Mm-hmm. They're trying to protect the tenant from things like that, but who protects the landlords? Nobody.
No one.
Yeah.
Yeah, we're all the devils, basically. Yeah.
So
the people that don't own a home.
To answer, Anders, your question, I think we're at least probably 6 months away from looking at stuff at the right valuation for purchase.
Okay.
So what does that mean in going from area to area? The information I'm privy to, we are probably 26 to 30% overvalued right now in Naples, so I would like to see that drop before I invest a dime here. Other places like Tampa, I think are a little bit higher. I think you guys are about 30 to 35 maybe overvalued due to the inflation. That's what I would wait to see. But here's a little trick that a lot of people don't know. I'm going to give you a little inside information. Number one, we don't really track the Fed for what mortgages are doing. We track the 10-year Treasury.
Mm-hmm.
That's what you watch.
Mm-hmm.
Now, I can take you back to the last 3 recessions, which is when we basically started tracking this stuff, as a government. And I can show you that every time the government pauses, like they just did, and reverses, starts bringing the rate back down a little bit, it's not till about 6 months after that we actually hit the bottom in values. And that's always kind of been our yardstick.
In the real estate market, you're saying?
In the real estate market.
Yeah. Yeah, well, usually that doesn't make sense. I'm just curious, something I have heard, because we're in, we're not at any point like in the bottom of a recession right now, although I think, we're getting, it's coming, as we've been talking about. But we're also in an inflationary environment right now, and so people, who do have money,
that's what causes a recession.
Yeah, often. But there's we have deflationary recessions that have happened too, or at least recessions where inflation is not this high. And so if you have everybody who has money trying to look for a place to put it, do you think that could still be something that puts upward pressure on real estate? Because real estate generally always, is a store of value. And so we're in an environment where, it still could have that pushing it, even though, maybe prices are still high where they're at. You have an inflationary pressure, even though you're going into a recession.
That's kind of a bit of a loaded question because there's a lot of factors that come into play. Mm-hmm. So deflation is usually a part of any recession at some point. Right? You have your inflation leads up to the recession. People have less money to spend. The money they do have to spend buys less, right? Okay. So now what happens is at some point the pressure is downward in the pricing, so the stuff can be moved. right?
Mm-hmm.
If that food's sitting on the grocery shelf, it's got a shelf life, and if it can't get moved, it goes bad, right? So at some point, someone says, "Hey, let's blow the meat out that's more than 3 days old. Half price it or whatever." That's when you're deflationary. That's when you start seeing this. So in real estate, there's a lot of different stores of value, and real estate's competing with gold, is competing with oil, is competing with a lot of different other commodities. But the whole point of the real estate is because it's a revenue producing asset, hopefully, right? But if nobody's got the money to spend, and if the rents go down, which you're going to see that coming too, the rents are going to go down. Because I can tell you what happened in the last late grade unpleasantness of 2010, where all of a sudden it was a race to the bottom because people were like, okay, well, I can't afford to pay you $3,000 a month for this house, even though your mortgage payment is $3,200 because you bought this at the peak. A lot of that going on here. Okay, so now they look for something cheaper. So this guy says, well, I'll rent you my place for $2,700. And then the other guy goes, well, I'll rent it for $26. And finally having something is better than nothing. But at some point, what happens is these people end up getting out of the market as owners because now they can't make their debt service because the rents don't support the price they paid for the house. Like Airbnbs, I think they're going to get slaughtered here.
Yeah, I don't want to shit on Ryan or anything because he's an Airbnb owner.
I'm talking about my market. Ryan's market may be different.
I got you, but I'm saying in a recession, obviously, people are taking less vacations, and and it's already in a lot of places it has become super saturated. You could be in a smaller area, but Florida's like there are a lot of Airbnbs around here that people just bought, especially during COVID, and turn them around, and everybody's trying to rent them out, and the market's kind of flooded. I feel like.
So another part of this too is what's the dollar doing? Because I can tell you, Naples, a lot of people from other countries come here. A lot of Canadians own property here, unfortunately, but we get all these people from Europe, and they come on vacations or they come in to buy. But a lot of it too is based on what's the euro doing against the dollar. When the dollar's strong, they tend to buy less. They wait for the euro to be a little stronger because now they can buy more with their money. Right. So, but now if you're having a global recession, all bets are off when it comes to the monetary policy there. Sometimes both the euro and the dollar will dump. Yeah. Because the government printed all this money during COVID for a number of reasons, handed a lot of it out. You hear people talk about the great resignation of people in your generation, right? What resignation are they talking about? They were told to stay home. They couldn't work. Okay, and then they called them back to work. Half of them or more didn't show up. Well, why? Because they got this money from the government. And they said, well, I'm going to start a business from my home. So now I don't have to go back to work. Okay? Like, I don't know if I shared it with you, Ron. I think I did. But typically every year, you've got about 620, 630 businesses that start up. You've almost got the same, maybe a few more that close out, that close their doors every year. That's always been the number, almost practically since the 80s. Okay? The 2 years of COVID, that number went from 620, 630,000 to 4 million and 5 million, respectively.
Yeah, it's
a jump.
A huge increase.
There's your resignation. That's what happened. Oh, I'm not coming back to work. I'm starting my graphics design business from my house. I'm working from my computer. I'm working from home. Right? How much have we heard about working from home? It's the new norm, right?
Yeah.
No. It's not the new norm. I think it's better than it was before COVID. Okay. But there's a lot of companies, including, hell, look at Elon Musk, his company, Tesla. There's a lot of people they had working from home. They're like, okay, now guess what? Everybody's back to work. Come back in. Yeah. Oh, we don't want to. Here's your pink slip.
Pretty much all the major companies did that. Twitter.
Microsoft's laying off people. All the tech companies are taking a smack.
Yeah.
So it's just part of what's coming. But, until you put this together and stir it in the same pot, you don't really get the aroma of what's really cooking. because people are very focused on just singular things. Like if I talk to realtors are like, well, we're at the same price, maybe 4% different than we were last year when we, sold stuff. There's a 4% drop in value. It's only 4%, big deal. Could be this month, the next month could be something else. Okay, well, how's that? How's your buyer demand? How many buyers are you working with right now? So I can tell you buyer demand, almost non-existent here.
Yeah.
Fear. And Naples is like, we've have a history of having international buyers and everybody from the COVID thing, everybody's wanting to move to Florida, right?
Mm-hmm.
Okay, buyer demand fell off a cliff, non-existent. For mortgage applications, have you seen those numbers?
Yeah, they're way down.
32-year low.
Yeah.
So, I mean, all this stuff you have to factor in the long term. But like I was telling Ryan, I said, look, if you're focused in a specific area, you watch the trends for that area because real estate is local, no matter where you are. Yes, there are some general concepts, on a national level, like interest rates and stuff like that. But, you got to watch what's going on in your market. And maybe the cycle in Ryan's market might be a 7 or 10-year cycle, not a 15-year cycle. Maybe he has shorter, harder cycles. See, like with us, when the late grade and pleasantness of 2010 came, we dropped 40% in value. Some places 50. We were cut in half. It was so bad that our board of realtors would not report the numbers to NAR for 2 months because it was so awful, and they didn't want anybody seeing it.
Wow.
You don't see that kind of correction though coming now. You think it's going to be more mild?
I was figuring instead of 40%, I was figuring close to 30, but now I have other people on my team going, it may be worse than the last one.
Really?
And when
so
you're
50,
expecting,
50 you're saying it's going to be worse. 50, you're going to say, well, it's probably going to be the same, maybe less.
and you're expecting that to happen within the next 6 months?
I'm expecting, I don't know if it's going to be in the 6 months. Look, here's real estate markets don't crash in a day, a week, a month.
Yeah.
Even a month, even in a year, the market doesn't crash. From the peak at 2010 to the trough, what I call the trough, which was 6 months after the Fed said, okay, we're going to start bringing rates down again. 6 months, almost to the day, is when we hit bottom. Okay, that time span from top to bottom was 5 years.
Yeah, 5 years from the peak of the market to the bottom of your market.
I see.
Yeah, because real estate's a slow decline.
Well, everything we
like
see,
the stock market.
remember a lot of the information we're getting and the Fed and everything else, these are all lagging indicators for the most part. Now, when you're looking at credit card debt, personal savings rates, they're a little sooner on the lagging scale because they're real time and they're like last month. But so I mean, markets don't crash in a few months.
Interesting. And I guess, I mean, I guess it just depends on what your plan is too with real estate. I think for Anders and I, we probably plan on holding our properties for 10, 20, 30 years, I mean, that's my plan.
You won't hold it for 30 years. I guarantee you that. I doubt you'll hold it for 20.
You don't think so?
No,
really?
I can tell you when I got into real estate, I want to build a big portfolio, of like 10, 20, 30 houses. And I said, well, that'll sustain me till the day I die. And then you start realizing, well, shit, got to pay for an AC unit. Got to pay for, and I think single family residences are probably the most inefficient real estate investment vehicle out there. Only because you're either at 100% occupancy or 0% occupancy. There's no in between, right? If you got multi-units, okay, you could be at 60%, you could be at 50, maybe you have to be at 40 to make your debt service, whatever, right? There's more options there. But when you've got single family residences, and that's what I had, you start realizing between delayed maintenance and everything else, there comes a point where when you first own it, if you don't have to fix anything, your ROI goes way up. But as time goes on, and you're dealing with tenants, destruction, roofing, ACs, your ROI starts going down over time. Then COVID happened, and then inflation happened, and then all of a sudden, I'm looking at prices like, damn, I'm going to get bailed out of this.
Interesting.
Right.
And that's when you take advantage of it. So if you guys are smart, and I think you are, you'll wait till the next time things really spike up high. You'll be like, maybe now's the time to cash out because we're looking at fixing this, fixing that, whatever. The rents have gone down, maybe. Let's cash it out. And that's exactly what I did.
Yeah.
So what'll happen is my cycle starts all over again, right? So when we hit our trough again, I'll go in and buy things,
Scoop it
whatever,
up,
and then start that whole cycle again.
Gotcha.
Wow.
Oh man, I feel like
I see the wheels turning, man. I see
Yeah.
the wheels turning.
Yeah, I'm kind of speechless. It's a very compelling, I guess, not argument that you're making, but you obviously know what you're talking about, and in a way that we just don't have the experience in just investing in these markets for as long as you have. So I'm taking everything you're saying.
I know guys who swear on single family residence. They swear on them. Yep. You got a whole portfolio of, some of them are free and clear, blah, blah, blah. Okay, that's great. And that's more of a condition of circumstance. Okay. But, I personally, I'm not crazy about the single family residence as a means of, and I got to tell you, when the whole short sale thing came about in the late grade and plus in this, there were guys who were calling me, okay, and probably a couple of these guys, you've probably heard of them because they sell education, real estate education. Okay. Some of these guys owned 40, 50, 100 houses in various places, a lot of it up north. But I can think of one guy right off the bat who's like, he went bankrupt. He went bankrupt. And he's a guy you've heard on the radio. I guarantee at some point you heard a commercial that this guy was selling how to buy houses.
Interesting.
And this guy was talking to me and he's like, can you handle a couple hundred short sales for me?
Wow.
And I'm like, I said, Ron, I said, as much as I'd like to, I'll take 15 years off my life if I do that. And he ended up losing the majority of his portfolio and going bankrupt.
Wow.
Yeah. No, he still sells, his education.
Yeah.
But, most of the guys I came up with in the system back when this all began, a lot of these guys, you've probably heard some of these guys' names. Than Merrill, you know who Than Merrill is? Flipping Boston. Google.
Okay.
He's kind of a big deal on the Discovery Channel or something. But a lot of these guys, I know these guys. I met personally Than. I used to have his phone number in my phone. But a lot of these guys, they got out of the real estate business a decade ago.
They just cashed out, or no? They got squeezed out.
Let me put it this way: their TV shows and stuff gave them notoriety and credibility, but it was to sell real estate programs, not.
I remember you mentioning this.
They're in the education business, they call it.
Yeah.
And I used to look at these guys and go, so you guys are pretty much making more of your money in education than you are in real estate. They go, yeah, pretty much.
Wow.
And so I said, yeah, no, I'm going to stick to what I know.
Yeah.
What are your thoughts on because Honors and I Honors converted his single family into a duplex, and mine's a duplex, and the reason that we bought where we did is it's near a national park. I think it's more recession proof than maybe a place like Naples where people want to do these little day trips out to Yosemite or go up to the mountains and go skiing. Sure. It's a little bit more affordable with a family vacation, so I think maybe I'll fare better there. But what are your thoughts on duplex investing?
I like duplexes as long as you're. See, the problem here with duplexes is most people are overpaying for them. My rule of thumb is, whatever your purchase price is on a duplex, you need to get 1% to 2% of that purchase price as a rental rate. If you're not getting that, because, unless you're living on one side, that's another situation, right?
Yeah.
But most of the people here I see when they're buying duplexes, each side is getting $500, which to me would indicate a purchase price between 100 and 200,000, let's say.
Hmm.
Okay. They're paying 350 for them.
Mm-hmm.
So how do you even pay for debt service at 350 if you're renting it out for $500 a side? That's $1,000 a month.
Can't.
$1,000 is 1% of $100,000. Let's say we go to 2%. So 200,000 would be still appropriate, I think, fair. But if you're paying 350, you're almost paying your debt service is almost double, almost, maybe a little less, than what you're taking in for rent. And I'd ask these people, well, why'd you do that? Well, because I was going to increase the rent, but I really couldn't get any more rent, or I thought the place was going to be worth $100,000 the following year, and I was going to sell it. That didn't work out. A lot of weird reasons why people do that here. I don't know what that's like in your neck of the woods, but
in St. Pete, they're
St.
really,
Pete's probably
they're really expensive, and I don't understand. I feel like some part of it is like everybody. There's a feeling now where everybody wants to be a real estate investor, and then they just think, oh, duplex, that's instant money, whatever it is. And then these prices are bid up to like outrageous amounts, and people are paying.
Correct.
Like,
so you understand, you've seen exactly what I'm talking about.
Yeah,
Same thing in San Diego.
for a duplex. And I'm like, you're not, that there's no way that makes sense, especially at this interest rate.
A duplex here is minimum 700,000 to 900,000 in San Diego.
But what do they get each side?
It depends on the size, but maybe 2,500 to 3,000 a side, I would say.
So unless they were getting 3,500 to 4,000 each side, to me that wouldn't be an acceptable. And here's the problem when you're dealing with the top end of the rate. That top end could drop out at any point, right? If you're at the top end of the rental rate, the top end of the market, okay, and you're paying $3,000, $4,000 a month, that ain't going to be like that forever.
Yeah.
You're going to have a cycle where, okay, that rent's going to have to go down to $2,500 if I want somebody in there. Now
it'll flip.
Yeah, when you're at the expensive like price points for rentals, someone's going to try to do is move into something that's all right. I can move into a not of a nice neighborhood, not as a good school district, try to lower my rent, and the people, those more luxury, more expensive rentals to the top, I feel like get hit in those situations.
Absolutely. I'll tell you one of the things, and I don't know what it's like out in California. It's probably better than it is here when it comes to this. And I don't buy these in Florida, but I'm a big fan of mobile homes and manufactured housing. Big fan.
Like
I've owned a few of them.
You talked about just each individual house, or like the whole complex? As like
if I can buy a park, I'll buy a whole damn park. But I've owned individual units. As long as I own the land.
Okay.
As long as I own the land, I'll buy them all day long. Number one, they're easy to fix. Number two, if they get that banged up, you buy another one. And the cost per square foot of those are way less than having something built. Number three, I get just as much rent for those as I can for a stick built or a brick built in North Carolina. At a fraction of the cost.
As far as cash on cash. Got it. Interesting.
So, no, a lot of people are like, mobile homes, it's just not sexy. I don't care about sexy. There's a guy I studied under, his name was Scruggs, Lonnie Scruggs. He's passed now. Good old boy from North Carolina, guy out of the Navy, just started buying mobile homes. His book is still out there. I think it's called Deals on Wheels. And what Lonnie...
Love that.
Right? What Lonnie taught me as he goes, in his very Southern Virginia voice was like, mobile home is tin can that spits out money. And I just got such a kick out of that. And, and I took what he said to heart, and I've owned a few, and I really enjoyed owning them. They have their challenges too, but and depending on certain neighborhoods, it's like, that seems to cater to the lower side of humanity or whatever, which is not necessarily true. I mean, I would live in a mobile home. I mean,
Yeah.
and one of the ones I owned, excuse me, was almost an 1,800 square foot double wide
Hmm.
on a beautiful piece of land, you know? And I said,
Yeah.
man, if I could have a house like this, even a mobile home on 10 or 20 acres, I'd be
Mhm.
happy as hell.
You know, funny story, Anders, maybe you can talk to him a little bit, but Anders used to live in a mobile home for a little bit.
Yeah, I mean, when you're in California, it's great. It's way more affordable than a lot of
It was
your
a
other
nice
options.
neighborhood.
So, yeah, and
They had a nice
that's
pool.
the thing is whoever. I mean, if you're going to be in like a park like that, it's all about whoever's managing it because you can be in something super nice where they're just on everybody for every little thing that goes that they could be doing
Yeah.
wrong, or you could be in the one where they don't care and then it's ends up trashy.
Well, I never owned any in a park. I would never.
Mhm.
I don't let anybody dictate what I can do with what I own.
Yeah.
So I would buy like these 1 acre pieces. Like North Carolina has these 1 acre lots where, there's a mobile home on each one. And it's like anything else. It's like a house.
Mhm.
It's just your house, your mobile home, no deed restrictions, whatever. And those to me seem like the best because it just seemed more like a regular living condition versus,
Mhm.
Mhm.
being in a park and being next to a neighbor and they're all jammed together or
Yeah,
whatever.
that makes sense.
But yeah, I mean, I think, I'd be remiss in not telling you guys that, look at those opportunities. I mean, manufactured housing, the last time I looked at statistics, outside of Florida, the rest of the country, 40% of all the housing is manufactured housing.
Holy
Wow, I
cow.
did not know that.
That could be modular, that could be manufactured, that could be double wide, single wide, whatever. 40%. That was the last statistic I saw.
That's crazy.
Wow.
In certain places, it's conducive to live in those things. Like
Mhm.
Florida, I don't know. I could tell you what happened with the mobile homes that got hit by the Hurricane Ian,
Yeah,
Mhm.
I wouldn't
in
want to be
Fort
in one
Myers
around
Beach.
here.
I don't know. I think they're in the Gulf of Mexico someplace. But I mean,
Mhm.
another place like North Carolina, there's no reason. We
Yeah.
don't have, there was no hurricanes up there and, in the center of the state. And, people are like, well, what about rainstorms and hail? Yeah, we've had hail. And a hail can damage a regular roof just like it can any other roof. And my insurance company came in and replaced the roof.
Mhm.
Mhm.
I have a plumbing problem. I crawl underneath it, open the skirt up, go underneath. The pipes are all there.
Hmm.
You don't really get plumbing problems. You're not cracking open slabs. You're not doing any of that stuff.
Right.
And
Interesting.
you have to also consider one other thing that we haven't really talked about, and that's the demographics of the people who are going to be looking for housing. Okay, you've got a lot of baby boomers. That's a huge generation of people, over a 15-year span that have to retire.
Mhm.
You think they want to come to Naples, buy a $750,000 house so they can have a new mortgage payment in their 60s, 70s, and 80s? Hell no.
No.
You're going to see a lot of these families, a lot of these empty nesters. My plan is when things start coming back around, I'm going to be looking at 2-bedroom, 2-bath houses, not 3-bedroom.
Hmm.
Number one, I get a better price on a 2-bedroom.
Mhm.
Number two, empty nesters, baby boomers, they're going to be downsizing, not upsizing.
Mhm.
The next
Interesting.
generation is Gen Xers. I'm a Gen Xer. And Gen Xers are probably one of the most frugal. We don't like to spend money. We grew up, hearing the stories of the Depression and everything else from our fathers, parents, and grandparents, whatever.
Mhm.
So,
Mhm.
and Gen X is a very small generation.
Hmm.
Numbers wise, it is the smallest generation.
Hmm.
So we're almost an extinction of the baby boomers, but with a different mentality. But baby boomers over the next 15 years, these people own businesses. They're retiring. They got to go someplace. And I
Mhm.
don't think they want to spend $3,000 a month on a mortgage.
No.
They want to travel. They got health issues they need to address financially. We call it the
Yeah.
silver tsunami.
Huh. The silver
Yeah.
tsunami.
I guess
And
you
you
got to
guys
do.
you
You got
guys
to
would
watch
be smart to
demographics like
understand that demographic.
Mhm.
Very
And
interesting.
that's where all the money is, believe it or not.
Yeah, it is.
Millennials and Gen Yers and all these, that's not where the money is.
No.
I mean, I love millennials. God bless them. I mean, it's a pretty big swath of people, and I know, millennials in their late 30s approaching 40, and then I know some at the other end of the scale, and there's almost two different kinds of attitudes there.
Mm-hmm.
But they're not having the financial success that the Gen Xers and the baby boomers had. They're just not. It's a different time. They've been brought up under different, conditions and stuff. I think people younger than Gen Xers want to have an experience, right? Everything's about the experience, right? Where Gen Xers and baby boomers, we were taught, just put your nose to the grindstone and work. Have your fun later. Where I think millennials, God bless them, they want to have their fun now. But that's not conducive to a high savings rate, and long-term careers. So it's a different cultural thing going on too, right? But yeah, I would definitely, if I were you, pay some mind to the what's changing and shifting in the demographics as well. And you may find opportunities for 2-bedroom houses, which will be way cheaper than a 3-bedroom house.
Yeah, I mean, I'm all about them. That's what I got. So I think they're at a little nicer price point, and
absolutely,
it doesn't mean if you get the right square footage, you can add one too. Still,
it could.
But, yeah, man, I feel like I got a lot out of this. There's a lot of little hot tips there, and certain things that I hadn't even thought about, and different strategies. So,
that was my goal today. My goal is to bring some enlightenment to you and the people who listen, that consider some things you haven't been considering, because I think education is key to anything. And even at my ripe old age, and I'm in my 50s, I still do a lot of education, a lot of different things. And I have a lot of wisdom to impart on anybody who's willing to listen. So
yeah, say for anyone who's listening to this and wants to find out more about you, or are you do you have anywhere people can reach you or reach out to you or anything like that?
Absolutely. I'm, if you Googled my name, which is Sergio DeCesare, DeCesare. I mean, I'm quite easily found on Google for a number of different things. I have a website called maxbusinessprofits.com, and that's for my practice. A direct line to me would be my email address at sergio@maxbusinessprofits.com. And, I don't mind sharing my phone number with anybody. It's 239-580-7408. I love to help people out, and I've given out probably far more free advice than I've ever gotten paid for. So,
well,
it goes around.
We really appreciate your time. Yeah, exactly. What goes around comes around, and we'll have all of your links in the description of this video and wherever else the podcast gets posted. So,
excellent.
This was really amazing, Sergio. Really appreciate your time once again. And
it was a pleasure. It was fun talking to people who actually want to know what's really going on. So,
yeah, this was great. We may have to invite you back someday.
Absolutely.
Awesome. Well, thank you so much, guys. Have a great rest of your day.
All right. You too. Thanks so much. Good meeting y'all.